let's go specifically and look at double distribution days, because that's what we want to talk about today. We want to talk about why these double distribution days in essence occur, what creates them, and ultimately what are the factors that we want to utilize to determine, a strategy from them. Okay, now in terms of double distribution, what you will notice, okay, I'm going to actually just draw on this graphic as well so you can understand it. Let me just find my mouse. Okay, so what you'll notice from a double distribution that I explained is that we have effectively two separate value areas. Now, again, don't be confused if I say this is the value area in terms of market profiling, or this is the value area. Okay, they are just two different types of profiling. One on the left is market profiling with TPOs, and the one on the right is volume profiling. Okay, in essence, they both have got two unique value areas, and that's how you distinguish a double distribution. Okay, it's two unique distinguishable distributions. Okay, so you can see here a lot of time spent here and a lot of time spent here, with very little time spent in between. Okay, if we look at the volume side of things, we can see a lot of volume transacted here, a lot of volume transacted here, with little volume in between. Okay, right next to it on the right is another double distribution day. So we got two double distribution days in a row. We can see a lot of time spent here, a lot of time spent here. Okay, quite a bit of volume spent here, but most of the volume spent here, and nothing in between. Okay, two distinct double distribution days. Now, what you'll also notice about double distribution days, or how you identify them, is that they'll typically have 2 points of control, or 2 volume points of control. Okay, now what I mean by that is, if we look at the first example, we can clearly see that the point of control, okay, which is the point at which the market spend the most time, is very obvious here. However, we can see that we also spend quite a lot of time over here. In essence, either one of these could have been deemed the point of control. Now, this is where I said to you right in the beginning, the reason professional traders prefer volume over time is because what you can see is this point of control was created in the overnight session. Okay, versus this point of control or this potential point of control on the bottom was created in the cash session. Okay, and that's why we can see the point of control is up here, but the volume point of control is down here. They're two different locations. Okay, now I don't want to confuse you. The point is with double distribution, typically what you're going to find is there are 2 points, whether it's volume or time, at which you could call it the area where the market spends most of its time. Okay, if we use the second example, again, we can see the market spend most of its time here. Okay, it also spent most of the afternoon time here. In terms of volume, we can see in the overnight session, that's where most of the volume is transacted. And during the cash session, that's where most of the volume is transacted. Okay, so that's what's typical in a double distribution. 2 values, 2 potential points of control in the market. Okay, we also then have the market shift, and this is key. All right, this sets of single prints or lack of trade occurring over there and occurring there, we call that a market sentiment shift. In other words, something has triggered, something has changed in the nature of the market over the course of the section, and it's auctioning, looking for liquidity. In other words, we see some price discovery taking place in search of liquidity. Okay, and then finally, we've spoken about volume analysis, where we can look at the volume with the 2 different sessions, effectively, where they've traded over 2 different sets of prices and what that volume looks like. Now, the key to understanding this strategy can be done effectively. I should have a look in terms of the next slide here. Okay, so what I'm going to explain to you in essence is that the factors we are looking at in terms of double distributions, and I'm going to show you how the strategy works. Okay, now if I just delete this quickly, erase this, what we are in essence looking at, okay, let me take one step back. There's 2 ways you execute a double distribution. Okay, the one way is we look for continuation. Okay, so let's draw out a double distribution. Okay, the one type of strategy, what we're looking for is we're looking for a continuation of the price discovery mode in the next session. Okay, so the play I'm showing you is the day 2 play. So day 1 is this. You can see the double distribution. You come in the next morning and you're looking for a continuation of the double distribution. Okay, the other play is we're looking for effectively that low volume area to trade out. In other words, we're looking for the market to test in the lower bounds, but come back and ultimately fill out that area where it auctioned through the previous day. That's the 2 plays you get from a double distribution. Now, there are very specific characteristics that will tell you which way you want to play the strategy. And this is the art form around the strategy. This is where you have to understand the context in which the strategy is being created. Okay, now there's two things we look for. Number one, we look at relative volume. Okay, now I'll explain to you what this means with a simple image. We call it skew. If you look at this example on the right here, what you'll notice with this double distribution is look how much volume transacted in the lower value area versus the higher value area. Okay, so we're looking at the skew. Now, the general rule of thumb, remember what I don't want you to do is I don't want you to go away now and say, if there's a high skew, there's a high probability of continuation, and that's the way I'm going to trade it, and I'm going to be biased to trade it always that way. Okay, however, as a baseline rule of thumb, when we have got a high degree of skew, in other words, there's a significant amount of volume relative to you, typically the next day we see continuation. Why? There is some logic behind this. Okay. Now, what it is you got to almost think of it in terms of like a volume weighted average price. In essence, what's happened here is that the market has spent a large degree of time just transacting in the upper bounds. And all of a sudden, something has triggered the market to very quickly auction away, but then in essence, go and transact all of the volume lower down. In other words, the market has found liquidity lower down, but it's transacted a significant amount of volume and it's accepted this as fair value. Okay, and that's really, really key. When we have a massive skew, what it's in essence telling us is there's a great degree of acceptance or confidence that these are the prices we should be trading at. Okay, versus if we had something more balanced like this, it's telling us that, sure, there's a great degree of acceptance here. However, there was also quite a high degree of acceptance at this price point as well. Okay, so in general, the greater the skew, the more likely we are to continue. The less of a skew, and I'll show you quite a few examples today where we talk about skew, the less of a skew, the more likely it is that the next day we're going to come in and balance out within this area. Okay, that's rule number one, or factor number one, that we look at after day one where the double distribution is formed. The second thing we look at, and this is key, we look at the price location where the trigger has occurred. Okay, so remember I said to you in terms of double distributions, the market spends a lot of time auctioning here, and all of a sudden there's a reason the market does this before it runs into liquidity. And what we have to interpret is we have to put a big fat question mark at the end of the session and say to ourselves, why did this auctioning process occur? What created it? Now, it can be created, for example, by breaking key support. Okay, if we break key support, that is the trigger that created the auction process. Okay, it can be triggered by stops being run. So perhaps maybe the market's sitting in a massive sideways range, and slowly but surely we were building value higher, and all of a sudden short-term stops got triggered. Okay, maybe the market enters and breaks into new record highs. There's a number of reasons why these auction processes take place. Okay, it can happen because of economic data. It can happen because of a central bank event. We have to answer the why, because if we know the why, it will give us a very good understanding of whether or not we're going to continue or if we're going to reverse. Okay, now, what I want to show you is I want to show you a few examples so you'll start to understand the whys, okay, and what it comes down to in a basic sense. And this is kind of, as a rule of thumb, this is how you have to look at it, okay? If, for example, the market's why is because we're now entering a new area of prices, okay? So, and the best way to illustrate this with traders is talk about resistance and support, okay? So, if the market is sitting inside of a band of support and resistance, now I'm not talking about 5-minute resistance and support and 50-minute, I'm talking about daily, weekly, monthly, okay? If we're sitting inside a big area of support and resistance, and in essence, our trend is flat, so we have a moving average that's predominantly moving sideways, okay? What typically happens is that as the market is trading between these 2 points, we start to develop some positioning. So as the market comes up here, there's more longs in the market. And what will typically happen is on the way down, we flush out those longs. Now, when we flush out those longs within this broad range between support and resistance, very often, or most often, all the time, those double distributions are going to be filled out. Why? Because the reason for the trigger is not because suddenly everyone wants to be short. It's simply because buyers had to liquidate those positions, okay? And when they liquidate those positions and their stops get triggered, we create these little auctioning events, okay? These low volume events. But typically speaking, the next day we'll come out and fill out those areas. Now, if I stretch that and I say, let's remove that context and put it down here and say, okay, the market distributed for the entire session in the lower bound ahead of the support, and suddenly we snapped lower and found liquidity there. In those instances, because of the context of where the trigger occurred, we're more likely to continue that trend the next day. Okay, so those are the two factors with double distributions. Number one, what is the volume skew? And number two, where is that trigger occurring in terms of price? What's causing it to occur? Okay, if you answer those two questions, you'll have a very good fundamental and technical understanding as to what's going to happen the next day with double distributions, and more importantly, how you should play it. Now, let's look at some examples, and then we'll move on and we'll talk about risk. How do we manage risk? Where do we enter? Where do we stop? Why do we stop? Okay, so 5 examples that I'm going to show you, and they're all recent examples. This is today in the German bunds. Okay, so in the German bunds, you can see today we've got a very nice double distribution. Okay, obviously today was ECB day. Now, very important, like I said to you, question number one, okay, if you want the dates and you want to go look at it, you can go look at it as the 25th of Jan. But this is in essence a position unwind. That's the trigger. Okay, what we can see over the last, now keep in mind, if you're not familiar with profiles, these are all days. So day 1, day 2, day 3, day 4, day 5. We can see over the last 5 sessions, in essence, we're flat. The market's not moving anywhere. But for the last 3 sessions, we can see that the market started to build value lower down the page. In other words, the shorts are accumulating a position. Okay, they're not necessarily aggressive. They're accumulating a position. And today, over the course of the ECB, those shorts came unstuck in essence, and they all effectively stopped out of those trades. Okay, now, based on what I've just told you in terms of the 2 things we need to look at. One, we look at the volume skew. So yeah, we can see higher amount of volume, and up here we can see a higher amount of volume. So there's not much, let me find my mouse, there's not much of a volume skew here. So straight away, instinctively, from factor number 1, there's a high probability that we're not going to extend tomorrow, and then in actual fact, we're likely to come fill out this area tomorrow. Okay. Factor number 2 we look at is the context. What created this trigger? It was these shorts that were stopping out of the trade. As a result, because of that factor, we also are inclined to want to sell this market, trade it back into the range, and let it fill this out. Okay, that's how we approach the double distribution. We use ultimately the skew of the volume as well as the trigger that occurred, and then we lean on whether or not we want to fade it or we want to go with it. Okay, now again, in a minute, I'm going to show you how you manage risk with this to make sure that you're not blindly fading a market or blindly buying highs and lows. Next example. Okay, this is S&P 500. As you know, we've broken out into record territory. Okay, now, as you can see in the S&P 500 on that breakout day, so Friday the 19th, we went into price discovery mode. Now, we all know price discovery means that everyone is buying. We have a breakout, we have initiative, everyone wants to be long the market. Now, for the first part of the session, if you were trading it, it was awful. It was horrible. The market was doing a huge amount of volume and time in the lower range of the day. We then traded the 41s, and the market began the process of auctioning higher. At the end of the day, we then accepted volume. So instinctively looking at this, factor number 1, what did the volume skew do? Well, we can see it's quite balanced. Okay, so our instinctive thoughts is that we may distribute lower the next day. Factor number 2, however, is what caused this trigger? Why did we have this trigger in the first place? Okay, we broke to record territory. It's a breakout. Okay, so straight away, if you trade enough breakouts, you know that you do not fade breakout trends. Okay, so that instinctively coming into this day, we're not looking to fade this market. We're looking to go with the flow. Now, in a moment, I'm going to show you how you go with the flow, how you fade it. In essence, this day, there was no entry. Okay, there was actually no entry from a double distribution standpoint. So there was no trade. Okay, but another fabulous example. The next example is euro dollar. This is from the 12th of January. And again, if we look at the skew on the breakdown day, we can see again, there's our volume in the first distribution, and there's our second. We can see a high degree of skew here. Okay, and very, very big difference in the skew in volume between the two distributions. And then number two, the reason or the trigger. Well, what we can see, I keep losing my mouse, sorry guys. What we can see here is ultimately we broke down below 1, 2, 3, 4 days of support. Market effectively broke out. Okay, so when we have these breakout double distributions, okay, you do enough of them, you'll start to realize that they typically extend. Okay, so that is another example in the Euro-Dollar FX. And then finally, we've actually got very nicely 3 double distributions in a very short space of time that occurred in December in the S&P 500. Okay, so firstly, we can see that we had a very big auctioning day on the 13th. Now, if you cast your mind back, the 13th of December was FOMC. Okay, so this was the pivot day in essence. So straight away, you got to be thinking, well, we were auctioning there all the day, and then the market effectively just went on a fundamental rally. Okay, again, next day, obviously this double distribution is not very well formed, but next day we've continued that double distribution. But then the following day, we formed a very interesting double distribution where the skew again is very, very skewed. Okay, so our instinctive reaction is we'd be looking for a continuation. However, context, where's the double distribution occurring? Well, it's occurring within a very aggressive fundamental move, which is a pivot from the central bank. Okay, in essence, that day, because of the price, we formed a very strong double distribution overlap day. And then again, we had another double distribution on the 19th over here, as you can see. And you can see the volume skew was very, very balanced. And the next day, within this sideways structure, you can see the next day we just filled that out. Okay, there we have it. A number of examples. You got the rough idea. Okay, let's summarize. 2 things we're looking for at when we get a double distribution. So at the end of today, go and look at your charts, go and see if any of them have formed double distributions. The first thing you look at, volume skew. The next thing you look at is go and look at the context in which that trigger occurred. Okay, now those 2 factors will ultimately determine if you're going to fade the market the next day or go with it. Now, the example I'm going to use to show you how we execute it is the German Bund, because this is what I have to do tomorrow as a trader. I have to come in and I have to execute in the German Bunds. So the first one I'm going to start with is the reversal, and then we'll come back to the continuation. Okay, so what you can see is the German Bunds and how we enter into this. Okay, if we're going to fade the market, okay, we need to make sure that we're entering as close to the value area high of that distribution as possible. Now, if we go and if we just look at this distribution, okay, and we find where 70% of the volume occurred, it will occur roughly within that price area. Okay, so somewhere around the 50s to 60s, we are looking for a short in the German Bunds. Okay, in other words, we're looking for the market to come up and auction and test effectively the high volume area that it traded for most of the afternoon session. And then what we're expecting it to do is begin the process of slowly auctioning out yesterday's range. Okay, in terms of then a stop, once the market shows us that it's in essence formed a top, we are just going to be risking. Okay, so if you're going to execute, if you're going to sell the value area high of this, you are going to place a stop above the high. However, we don't use just a price stop, we use a close stop. In other words, I do not want to see a TPO close above the day's high. In other words, if any 30-minute candle closes above today's high, I'll exit the trade. Okay, so we use a time-based stop as opposed to a price-based stop. Okay, and then in terms of the target, what we're looking to do is we want to see the market retest the starting point of the trigger. In other words, where did that trigger occur in the German Bunds? We can see it occurred down at 133.85. That's the point at which the buyers initiated the auction process. So that's what we're targeting. And once we get to that point, the expectation is that the market will turn back around and begin the process of trading between 133.85 and 134.38. Okay, that's the baseline approach to tomorrow in the German Bunds. Okay, Like I said, with this German Bund trade, we know that the skew in terms of volume is quite balanced, so that makes us think that it's a good sell tomorrow. We also know that the context is that it's within a resistance and support band. Okay, so because of that, we're going to come in, we're going to look to sell between 50s and 60s. We place a time-based close stop above the current day's high, and we're then looking to auction it all the way down to 133.85. Now, in terms of risk reward, we're talking around 65 ticks of reward, and we're talking around 10 to 20 ticks of stop, obviously depending what the market does above today's high. Okay, and you can straight away see that we've got 2 3-to-1 risk reward for this strategy play. Okay, now let's go and look at the continuation example. And to use this, we're going to go look at the S&P 500 when we had that very aggressive breakout to record territory high. Now, again, similar thing in terms of when we want to play the continuation play, what we're looking to do in essence is we need to give the market the opportunity to at least test the lower bound, the low volume area. Okay, so in essence, what typically happens is when a market does a double distribution, before it wants to continue, it's likely to come in and test this area. It's likely to test whether or not there is still liquidity being provided from the buyers. And it's at that point when the market starts to auction up that we effectively look to enter the market, and we then look to target an extension. Okay, now, like I said earlier, we didn't get an entry on this day. We could see the market effectively just opened where it closed and went straight bid. Okay, so there was no entry on this day. Effectively, the market never even tested the lower bound of the low value area. It just effectively went straight bid. Okay, but in essence, that's how you would do it. Let the market come back, allow it some time to test the lower bounds of this distribution. If you start to see liquidity there, if you've got a footprint chart and you start to see volume being accepted there, in essence, that's when you want to get long and you're looking for that continuation. Again, in terms of risk reward, why we like this play is because when we come in, we can see ultimately that if we enter around that low volume area, we know roughly speaking what price that is. Okay, so we can calculate from that low entry point to an extension of the highs. In this example, obviously, it was quite wide, quite a volatile day. But let's say, for example, we had 60 ticks of opportunity. In terms of stop, again, we got a very, very, very tight stop, perhaps only 20 ticks, 25 prices. So again, we're looking at very good 2-to-1 asymmetrical trade opportunity. Okay, that's the baseline approach to execution. Now, you won't ever hear me say when it comes to particularly profile plays, it's not about exact prices. It's not about you just put a bid at the low value area or sorry, the lower bound of the value area and you get filled and it is what it is. Okay. It is nuanced. When it comes to entering, we need to, in a basic sense, let the market test, in this example, the lower bound. But at that point, we need to use our price action skills to say, okay, I can see that volume coming in. I can see on the footprint, someone's reloading the bid. Bang, I'm now in. I'm getting in at an optimal price and I put my stop in. Okay, so don't ever look at this in terms of an exact price. Look at it in terms of a principle. The market needs to test that low value area. Once it fails testing that low value area and the liquidity is confirmed, that's the time I want to buy for an extension.